Psychology plays just as much of a role in technical analysis as the actual formation of the bars themselves and the trend lines that you could draw on them. I'm not heavily into trend lines. I'm not heavily into channel lines. The reason for that is that I feel that there's psychological underpinnings of the market, and I need to be able to look at the charts and specifically the individual candlesticks in order to make a determination of the psychology of the market at any given time. Are there more buyers than sellers? Are buyers running out of ammunition? Are they getting tired of pushing stocks higher? Are they interested at this level of taking profits? What clues do I have that after a market has run up, it's ready to reverse? Is it too soon to reverse? Is it simply a matter of a small pullback and not a major pullback? What constitutes a major pullback and a less than major pullback in which the market just simply trades sideways, consolidating before going higher? Those are the kind of questions that I want to answer before I take a position. So I wait for the best opportunity and I analyze the daily and weekly chart in order to find those opportunities. Most of the opportunities I find are best suited on a weekly basis, and then on a shorter term chart on a daily basis, and then a 4-hour chart. Trade anything less than a 4-hour chart, but I pick up my signals on the weekly chart, the monthly chart, and then I drill down when I find an opportunity at those two time frames. So in other words, I'm not going to be looking at an hourly chart, a 30-minute chart, a 5-minute chart, or anything less than a monthly or weekly chart in order to get my signals for a trade. I'm going to be patient and wait for the monthly or weekly chart to give me a signal that there's a potential reversal or there's a potential opportunity for a trade. And then I'll drill down into the daily charts, the hourly charts, specifically the 4-hour chart, in order to place the trade at the most opportune time. Now, spinning tops can also happen at the bottom of a decline. So for example, we've been looking at spinning tops at the top of advances, but they can also happen at the bottom of declines. Now, the 3 spinning tops that we identified that indicated that there's perhaps a reversal coming into the market are these 3 right here. And I'm wondering if you can identify a spinning top that showed the bottom of a market in which it was present and the market was ready to advance. Well, if you identified this one, you would be generally correct. Although this particular candlestick here does look like a spinning top, and there's the potential there for that spinning top to be a valid turn signal. The open and close are very narrow. It has a high tail, it has a low tail, and if you take a look at the volume, it's quite a bit higher than it was for the volume at the top. But what it looks like is that there's quite a bit, not only indecision, but the selling pressure is being met by buying pressure right here because we had an increase in volume here. So there was the potential there, although it wasn't very high, there was potential there for the market to reverse and go higher, which it did. However, that may be, it's not a high probability event because of the volume. But it did work out very well if you happen to take that signal. Now, there's another signal I see on this particular period for the chart. And we're going to be studying quite a few different charts to identify potential turning points in the market, looking for opportunities in which we can put on trades. In this case, we had, after this decline, we had come down into an area in which it looks like there was some support by this candlestick right here. We dipped down just about to the 24 level. We were at 26 here. This was going back to November of 2008 during the financial crisis. It looks like we had a little bit of a reversal bar here. We have a long candlestick here. It's a red candlestick, so it wasn't a positive week at all. but we did have a little bit of a down day on increased volume. Now, most of the volume, however, took place early on when people were trying to get out of positions. So there was high volume as we declined. Once we got to a lower low, actually volume declined significantly from those previous bars. You can see that the decline was fairly significant. And so psychologically speaking, if we were to look at this market, we'd say that, well, at this point, it looks like sellers were starting to dry up. There may not have been as many sellers coming into the market at this price level. You always have to kind of keep an eye on what price levels you're working in. So at this particular price level, there wasn't as much heavy selling as there was at these price levels. So you have to kind of wonder whether or not this is a level at which people want to continue selling or not. And that may be the case, that they don't want to sell at this level. So the selling pressure did start to give way to some buying pressure coming into the market. But then we took a second dip down into the same price area. And it's very important to look at price areas when using it in conjunction with volume, as well as the candlesticks that are formed. And in this case, after this little rally, we had another dip back into this price range. And at that time, volume was even lower than it was previously. In fact, significantly lower again. So now we've had most of the volume coming up into this range here, into the 40 level. This is the price range at which most of the selling took place. As you can see by the volume. As we came down, volume declined, showing less selling pressure. The relief rally that we had after that was once again sold off. And as the market came down into this area, you can see that volume was even lower yet again than this one. It means that selling pressure at this level is not strong. And so it gives us some idea that there's a potential for a rally. And that's exactly what happened. Right after this bar, this weekly bar, we had on light volume, so it looks like there was very little selling pressure coming into this area, already confirmed by the previous candlestick, and the market took off and rallied quite strongly after that, going from the 26 level all the way up to 50 in this particular rally. We want to look at the formation of the bars. We want to take a look at volume in relation to those bars. We want to take a look at the level of selling that comes into the market at certain price levels. And those are going to be the main clues that we're going to be using for technical analysis. Now, you may have learned technical analysis a different way. You may have heavily used and relied on trend lines, MACD, stochastics, maybe Bollinger Bands, or any number of technical analysis tools and indicators. I tend to go directly to price action to give me the signals that I'm looking for. They tend to be more reliable. I am not dependent on indicators to the degree I know a lot of traders are. And I think it gives me an advantage in the market because I can read the psychology of the market and I can determine when buying and selling pressure is coming into the market. All right, in the next video, we will continue our discussion of technical analysis.